Welcome back to Retirement News Online. Well, I think it's safe to say the average person's view of insurance is somewhat limited. These days, insurance has evolved and is used in many different ways in retirement planning. My guest is Curt Lyman, who practices at Alpha Beta Gamma in Palm Beach Gardens, Florida. Curt, always a pleasure. Thanks for joining us today. So how do you view the use of insurance in retirement planning now?
First of all, Scott, thanks. It's great to be back with you today. At Alpha Beta Gamma Wealth Management, we view risk management as a critical component of a client's retirement plan. Insurance is probably one of the single most flexible tools, and in recent years, with the new designs in these insurance policies, what we're finding is that it has become an invaluable tool in retirement planning for our clients.
So we've been hearing now more and more the use of insurance as an income strategy within a retirement plan, and also because of the tax advantages it provides. Can you talk about that?
Well, Scott, you know, there's death insurance and there's life insurance. A number of years ago, there was a whole insurance industry that was built up around death insurance. And death insurance is, simply put, term insurance. In order to collect it, you have to die. What's really exciting from our perspective is that life insurance now provides a package of benefits, including the ability to grow your assets at rates that are equivalent to the capital markets. As well, it can provide disability insurance for a client, it can provide a long-term care supplement for a client, as well as supplement a client's income through their retirement up until the point in time of their death. It's an incredibly flexible tool, and we think that it is a key component in most retirement plans that should be carefully addressed.
So it seems like this strategy has some broad appeal to, for example, professional people who are limited in how much they can contribute into their retirement accounts.
Absolutely, Scott. From our perspective, it is the single most important and first foundational investment that somebody just entering the workforce should consider making, not as particularly risk management or death insurance, but from the standpoint of building a solid foundation for the continued growth of their retirement plan.
So I think the average person watching might be thinking, this sounds too good to be true. Curt, are there any trade-offs with this kind of strategy?
You know, Scott, the thing about the life insurance policy designs today is that there are, but they're very, very few. There's a cost of insurance, but if you begin to buy insurance at a young age, that's nominal. And there are some liquidity trade-offs, but at the same time, the policies have now been designed so that you can borrow from that policy in order to provide liquidity for yourself. We've seen clients who have done this in order to fund children's college educations, to buy businesses, to buy real estate, and ultimately to pay themselves back as opposed to paying interest to a bank where they might otherwise have borrowed those monies.
Well, Curt, it's always great to speak with you. Thanks for joining us today.
Thank you, Scott. It's terrific being with you.
That's Curt Lyman in Palm Beach Gardens, Florida, and you're watching Retirement News Online.